All right, I'm gonna get started here. You have a clicker.
I believe more.
Thank you.
Yeah.
All right, hi everybody online. Everybody in person, thank you guys for coming. Just a quick introduction about myself. My name is Kelsey Curtis. I am a certified financial planner, a behavioral financial advisor, and I own Rushlick Financial Strategies. I actually specialize in working with business owners and real estate investors is my niche. So today I just really wanted to talk to you guys about a couple of different strategies that you can use when you're talking to your clients. So these are just things that will set you guys apart from other agents in order to best help grow your relationship with your clients.
Hey, here, how are you doing?
People trickling in. Left hand. Oh, there we go. I have to put this up here. This is not advice. And I cannot give tax or legal advice, so just have to have this up there. So let's talk a little bit about the importance of financial planning in real estate. So for those of you online, I know you don't have this paper in front of you, but if you would like a copy, I can email it to you. But as you guys know, when you're working with people, typically this is the biggest investment that they're going to make in their lifetime. And they might do it a couple of times, right? But for a lot of people, spending $400, $500, $1 million is a really, really big deal. So there's a lot of anxiety behind that for a lot of people. And you guys, as their trusted advisor, it's really important that you can kind of help quell that anxiousness and help them through the process. So what I want to talk to you guys about is just helping people make the best decisions when they're buying with you and helping them not feel as anxious when they're having this process or going through this process. Thank you. So what these things do is really just help take a transaction, you selling them a house or them selling a house or buying a house, and making it into their big picture. What does this actually mean to them? What is this property for? Is this their forever home? Is this a vacation rental? Is this something they want to leave to their kids? Do they want to get rid of it before they pass away? What's the whole purpose? And how does that actually fit into their entire financial life? And this really just helps your clients make better decisions and feel better about going through the process of buying, right? It helps anxiety, especially right now. A lot of people are anxious because interest rates are so high, right? They're like, oh, I'm gonna wait because interest rates are gonna come down. Well, as we've seen in the last year, they're not going anywhere anytime soon. And from my perspective, interest rates impact my world as well. Sometimes a little bit better because I can get clients more money and things like CDs or what have you because interest rates are higher. But what we're seeing and what economists I'm listening to, interest rates are pretty much going to stay the same for the next year-ish. I'm going to minimize you guys, sorry. Person can see all this. So really just enhancing those client-agent relationships. You guys are in a transaction-based business that you want to be relational, right? You want to have long-term relationships with people. You want them to trust you. You want them to refer people to you. But at the end of the day, you're doing a transaction with them. So how do you bridge the gap between those two things? Creating value for them, making them feel like you are the person to come to when they have questions. And how you do this is having a deeper understanding of the process, right? This is why you guys have classes all the time. This is why you're constantly calling your people, checking in and making sure that they're doing okay, that they don't need anything, etc. And when you are talking to people in terms of longevity and in terms of a long-term relationship with them, and you're saying things like, what is the purpose of this property? How long are we going to live here? What does this do for you and your family? That means you care, right? It's not just a transaction. It's, does this make sense for you? And as you know, a lot of times people get pre-approved for way more than they can actually afford. And you, as the agent, can come in and have that conversation with them. Hey, the payment is this. You're renting for $2,200 right now, and your new mortgage is going to be, $4,000 if you do this. Are you sure that this is going to be, doable for your family? What if one of you works for the federal government and they don't know what's going to happen with jobs, or, works for Boeing, whatever it is? Are we sure that we can weather those storms in order to do this house? Or maybe we look at a house that's a little less expensive, and then you look like the hero because you're actually saving them from making a mistake. Building trust. So educating clients around things, financial concepts regarding real estate. So one of the things that I always make sure people know, and I'm sure you all do, but question to you, how much, when people sell their house, it's a single person, like if I was to sell my house, what would I get on top of my cost basis from a tax perspective? What would be the break that I would get before I pay capital gains? Does anyone know?
250.
250, right? What do you get as a married couple? 500, okay? So knowing that is really important, right? Because when people come and say, oh, I don't want to sell because my capital gains are going to be insane.
Yeah.
Well, you need to know those numbers. You also need to know what happens if someone is going to sell after a spouse dies. Do you know what happens then?
Sure things saved.
You cheating? I love this.
They get a full step up for inherited properties to get 500.
Yeah, no, even more. So let's say a spouse, or let's say I'm married and I buy a house with my spouse, and I bought it in 1980 for $40,000. It's in Capitol Hill and I can sell it for $1 million right now. My spouse dies. I decide I don't want to live in that house anymore. We live in a community property state. What that means is you get a full stepped up cost basis when one spouse dies. So you can sell it for $1 million and not pay any capital gains. Huge,
So,
huge deal.
so as long as they're transferring the wealth, they buy another property. So
No,
They,
They don't have to do a 1030, you don't have to do a 1031.
but you would,
and you couldn't anyways because it's a private property, private residence.
Oh, yeah.
Yeah. So you get a full stepped up cost basis. It's a community property state. In states that are not community property states, that's not how it works. But for Washington, that's how it works. You get a full stepped up cost basis when one spouse dies.
so what I'm hearing you say is that if your spouse dies,
Mhm.
let's say you have $1 million
Mhm.
income, they pay no taxes on it because your spouse dies. Is that about right?
On the property.
On the property, right?
Yeah. Mhm.
Yeah.
Yep. So as long as you sell, and typically it's kind of a gray area with the IRS, so I'm not saying that this is the date, but typically it's if you sell it within a couple of years, you're not gonna pay that capital
Yeah,
gains.
that's-
Gotcha. It's not like if
From-
you live in
yeah.
it for 15 years, then you decide to sell it, it might not apply then.
Right, so you would have to pay, so they would look at day of death. What
Yeah.
the amount was that
Okay.
it was worth, which, how did they do that? Don't know, not my, not my world. But day of death, they'll say, okay, it's worth $1 million. Let's say you live in it for 15 more years and it's worth 1.2, then you'd have to pay capital gains on that 200,000. Does that make sense?
Yes.
So basically, so they can claim it for however long, they just have to pay, the property, depending where you are and what part of the country you're in, can depreciate. but they could sell it. And just have to pay capital gains on the gain they made after,
Sure.
whatever, is there a time frame, or you say about 2 years, is there?
I say about
Federal law
2
that-
years, and again, this is dependent on the IRS actually checking. I'm not saying to do anything, but I'm saying like, typically on day of death, like I would document. So if you have clients that have a spouse that passed away, make sure you go over this with them and say like, hey, we need to make sure that we make a note of this just in your financial documents of, here's an assessment of assessed value of your property on day of death for your spouse. You can stay in this property. I just want you to know this for tax reasons. Talk to your CPA, go through the process with them, but make sure that they know that this is the assessed value of your property.
Would it be assessed or appraised? Because there's a difference, assessed, you're paying where.
I'm not a CPA, so I don't know the answer to that.
It seems like it would be appraised or some sort of market analysis. Be worth to spend $700 if you could spend,
Sure.
save $1 million.
Sure.
Appraise, say, well, here's my
Yeah.
appraisal.
Yeah, absolutely. So I'm not sure what the IRS wants from that.
So your
Um,
CPA, 'cause
CPA would know.
so to borrow from Eric, just refer, if you have tax issues.
Exactly,
send to the CPA.
exactly. But for you guys, this is a great reason to reach out to
Mhm.
clients, right? Like especially when if they have somebody pass away, like it's a terrible time, they have a lot to think about. But just being able to, bring just this little piece of,
Right.
hey, I don't know if you're planning on staying in the home, just so you know, like there are some tax benefits now. And you can make some moves if you need to, and just having that kind of conversation with clients.
It's the same thing for kids when the parents die, is this?
Yeah. Yep. So inherited property is always going to get a stepped up cost basis. So there's two things in this world that have that rule with the IRS, and that is as of today. We don't know what is in the future, right? But real estate is one of them. And then the other one is if you have just a normal like brokerage stock portfolio. If someone dies, you get a full stepped up cost basis to that and on the day of death.
What's called stepped up cost.
Step up cost
Step up.
basis, yep.
And do you have to put that in a will or something for that, or
For real estate.
and both? And
So like for me, when like if I have a client pass away, I have to halt all trading on accounts for the day of death. So basically, day of death happens, I get notified. Everything in that account can't get traded or anything until it goes to whoever it's going to. And then if they decide to keep the, stuff invested how it is, that's fine. They just have to pay capital gains on whatever it earns after that, but they get that full stepped up cost basis.
okay.
So real estate is a huge benefit for investors, for just normal families because of that stepped up cost basis. A lot of places, a lot of other things don't have that.
So, but you're talking stepped up cost basis for personal property or stepped up cost basis for investment property?
All of it.
So just all of it.
Yeah, real estate in general, real estate as an investment gets a stepped up cost basis.
Great. So if I have a parent who dies, and they sell it, so I would get a stepped up cost basis. Does that mean I don't pay inheritance tax, or I still?
So inheritance tax is different.
Right.
So estate tax in Washington state is really, really low threshold. So if you have over $2.1 million of assets, any assets, house, car, checking account, whatever, you're gonna pay estate taxes in the state of Washington. 7.2%, I think, something like that. If you're over that 2.1 million, you get like basically an exclusion of 2.1 million, and then anything over that is you're paying. That's only in Washington. Some states have no estate tax. I tell people not to die in Washington for this reason.
Well, but how many people have 2.1?
But it includes your house.
Right, I know that.
I mean, here, where the median house is like, what, 800,000? It's pretty easy to get to that 2.1 pretty quickly. For federal, right now, it's at 13, I think it's 13 million, something like that for this year. And that's for each person, so 13 million for
But
each
if you
person.
looked at the demographics, so I would probably guesstimate, there's probably 20% of the people in this state have that.
Sure,
The vast number of people are just treading water.
sure. And yeah, it totally depends on your clients or your personal, you know, your
Good.
stuff. But yeah, if you have less than 2.1 million and you're inheriting less than 2.1, there's no estate tax.
So would there be any other attacks on inherited people other than the estate tax? That's.
No.
So basically, if the,
Not for real estate.
right,
Yeah.
well, yeah, and that's what I'm concerned about.
Yeah.
They asked that,
Yeah.
network, but it would, so basically what I'm hearing you say is that if your inheritance
Mhm.
is under 2.1, you
Mhm.
don't pay tax.
Correct. You do not pay estate taxes. The exception to that would be like if you inherit an IRA or a 401k
Right,
from whoever passed away. Under current law right now, you have 10 years to get everything out of that account. So you have to start draining it and you're gonna pay income tax on that money that you take out of the IRA or 401k. So those are taxed that way. Yeah.
so do you have any pamphlet or is there information? So, because this is, I've done this for a long time.
Yeah.
So I thought for sure that 250-500 rule had changed because that wasn't the way it was.
It has not. No, it hasn't changed. I think that it's been like this for
A long time.
a long time. I want to say like 20 plus years
Right.
that it's been like that.
Yeah,
But no, I don't have anything concrete. I can create something.
well, because the stuff, what you're talking about, that I don't know. I mean,
Yeah.
250-500
Yeah,
is, I kind of know, but
Mhm.
still there's distinctions in when that
Sure.
applies.
yeah.
And so, and the 2.1 really is what you're accumulating net worth.
hmm
And so it's more than real estate. It's like you said.
Everything.
Stocks and bonds, cars.
Yep,
personal
everything.
property. So.
Yeah, your total estate, as long as your total
So
estate.
are you being charged the 7.2% on anything over 2.1?
Correct.
Okay, so basically you get 2.1 clear.
Right,
you
right.
know, and then you
It's
have-
like the 250, 500. It's the same concept,
Right.
right? Of like, you get this exclusion before you have to pay the taxes on top of it.
Right,
Yeah.
yeah, okay, yeah, because suddenly, I mean, if you're selling property on the east side,
Sure,
you get that 2.1, probably most people on the east side.
quickly. Yeah.
Would be able to do that.
Yeah.
You're-
And it's a great conversation to be having with your clients too, because then you can be having a trust conversation or referring them to an estate attorney for a trust conversation. Because there are ways to get properties out of your estate. And I'll talk about a couple of them here in a minute.
So my next question,
Yeah.
Kelsey, so kind of what I'm looking for is like, almost like a decision tree.
Sure,
So if
Yeah.
you're here, this is the way you go. If you're here,
For
this is
sure.
the way, like you just said, if you have over 2.1, then you might want to look at a trust or when you look
Yeah.
at LLC or whatever. The different financial instruments you use protect your wealth,
sure.
because, a lot of my clients won't, but if like a first time buyer, and you can say, here's if you wanted to do it. here's
Right.
Something, then you're gonna submit yourself as, I'm here in the long term for you.
Right. No, and that's, I mean, that's how I typically work with real estate agents is with that process of, hey, look, if you are at this certain point, let's collaborate with Kelsey, with a CPA, see what we need to get done with an estate attorney and come together and have a holistic financial plan because everybody's different, right? And I have some people who, my aunt and uncle, sold a business. They don't care that the IRS is gonna get like $20 million. Don't care. Some people, that would just not sit well with them forever. And so it really just depends on how you feel about certain things and if you care that the government's gonna get, whatever.
If they're getting 20 million, then you're at, they're getting a lot of.
They did, but they just don't care about that piece, which
Right.
there's strategies where you could give that 20 million to a charity of your choice, but
Right.
they just don't want to deal with the headache of going through the process.
Right.
I totally get it,
Yeah.
but everybody's different. And so decision trees are great. Except it's hard when you don't know like what the whole picture is.
Right.
But I can definitely
Well,
work something
what
out.
I'm saying is depending where you are.
Sure, yeah.
Residential real estate or investment
Yeah.
real estate, Cause your choices are gonna be different for investment real estate.
Absolutely.
Because, I mean, in terms of cost of the construction or whatever.
Yeah,
A couple of years, we had somebody come here and say, well, that's actually better than just doing the whole fashion
right, right.
segregation.
Yeah, and there's different strategies for pretty much every single person in every different situation, but there are points in which like an LLC makes sense, or like for you guys as agents, like when you start making a certain amount of money, filing as an S corp makes sense. And having trust makes sense at a certain level as well. So yeah, great question. Okay, so really, one of the things that I work well with real estate agents is, like I just said, on the collaboration standpoint of, hey, how much can this person afford? What does it actually mean to them? Or using like online tools. There's so many out there, right? Like mortgage calculators and whatever that you can use to help your clients make good decisions. Understanding debt to income ratios and actually like what that means to your clients. For me, when I'm working with people on budgets, 9 times out of 10, people have no idea what they actually spend on things. And just having a really transparent conversation with your clients about like I said earlier, can you actually afford this $4,000 payment when you were paying $2,200? Like, how comfortable was that? Were you actually saving that much, $1,800 for every month to go into something else? Or where is that money? And so having those like debt conversations with your clients, making sure that they're comfortable with what you're going to be doing. And then really just tailoring your recommendations based on that, right? Like it's really important that you have your client's best interests in mind. And I know that's why you're all here, because you want to be doing what's best for your clients, right? And so making sure that you know what options you have for that. So long-term investment strategies, this is one of my favorites, in terms of what's the purpose of the property. How many of you work with real estate investors? Ish. So like some people, I know that like house hacking is a really big topic in your guys' industry right now, flipping houses, or, getting a duplex and renting out one side and living in it. And like, what is their overall strategy? What is the goal of what they want? And knowing things like, if you're going to buy a duplex and claim it as a personal residence on your mortgage, you need to live in it for 2 years. Knowing those things is really important, because some people think that they can move in and not live there, and that's not legal, right?
Is the rule I have to live there for 2 years? Because I've known people do it for 6 months.
It's 2 years. The rule is 2 years.
Right?
Yeah, so it's 2 years.
Yeah.
It's for taxes, for
Right.
tax purposes. Yeah.
So you have to, I mean, that's a different.
Yeah,
story.
because investment taxes are completely different than,
Right, because our people have
Right.
investment properties and they'll move back in the investment property.
right.
So they have to avoid capital gains.
Right. And it's again, not a CPA, it's a delicate dance, but knowing just enough to say, hey, like you need to, live in this for 2 years in order for it to qualify for a personal residence. Just to know those things is really important, because you don't want your clients getting in trouble either, right? That's not good. The IRS is not a fun place to deal with. And then knowing things like, oh yeah, go for it. Yeah.
Let's say they live in for 2 years.
Uh-huh.
And then they decide to rent it out for, let's say, towards the end of that, rent out for 3 years or, sorry, rent out for 2 years.
Mhm.
And then go back and live in it for 1 year to fulfill the 2 years.
Yeah.
Would they still qualify for that?
So it's 2 out of the last 5.
2 out of the last 5.
Yeah.
Okay.
So as long as it's 2 out of the last 5, yeah. So 6 months, go out, 6 months, yeah. So it's 2 of the last 5 is the rule. Yeah.
So basically, because I can see it, I've always thought of investment property, but vacation properties, is that some of the strategies people do, or like you say, 6 months on, 6 months off, or?
So vacation properties are interesting. So vacation properties, you can rent out any property for 14 days. No more, and claim it as a personal residence. If, yeah, so only 14 days in one calendar year.
Oh.
Calendar.
Yes.
Not for me.
No, 14 days in a year.
That sucks.
Yeah.
Yeah.
Yeah, so, but you could like rent out your personal home for 14 days to a friend and, you know, it could be rental income, and you don't have to claim it as a property, income property. If it's over that, you have to claim income from the property.
So, because I know now we're running to more max ADUs and DADs.
Mhm.
So those just, the old rental rules still apply, I mean, in terms of cost basis and all those.
Correct, yep. So, again, not a CPA, but from my understanding, you know, there's ways to get around things. But to be on the up and up, the rule is 14 days. Great questions. Property appreciation and depreciation are really good things to know about too, especially on the depreciation. For your real estate investment clients, knowing that you can have different depreciation schedules. So I have some clients who they like to own properties for about 10 years and then 1031 exchange into different ones. And so they used an accelerated depreciation schedule for those. So you basically take your property and you can depreciate them down faster. And it's things that you use. So you can like depreciate down the windows faster and the doors and whatever is like things that are usable within the home, you can depreciate them down quicker. And what that does is creates a larger offset against income. So essentially, it takes away a lot of the taxable income for the rental property by using an advanced depreciation schedule. And then you 1031 exchange into a new property at the end. So cool strategy. Very awesome if you have a really good CPA that will do it with you. So I have a couple of CPAs who primarily work with real estate investment, and that's all they do is work on depreciation schedules for people. So there's some cool strategies for that. However, at the end, you have to be cognizant of advancing your depreciation schedule. If you sell it instead of 1031 exchange, you have to pay back some of that depreciation if you do it at an advanced pace. So knowing those things is important, because they're great strategies for clients if they have way too much income and they're like, I don't want to pay taxes on this income, which who does, right? But there are ways to mitigate that through depreciation. Any questions? Yeah.
So I assume this is your website, freshlookfinancial.org.
His.
So if I had questions or I could go in there and you would have your brochures, whatever you have to.
I will tell you that my world is very regulated, my friends, and my website is pretty much like any other financial webpage you'll go to. If you need something, I can send it to you.
Right.
There's not a lot on real estate on my webpage, because I cannot create it. I'm not really allowed to do much of anything on my website. My broker dealer has to approve everything that I do. Love it. It's compliance. It's perfectly normal.
What do you mean your broker dealer? Are you working for somebody else?
No, so it's basically like John L. Scott, like I have to hang my license at a place. So everything that I do, like this class, I have to submit to compliance for them to be like, yes, you may talk about that. Everything. It's very highly regulated, which I love. It's great. Make sure I'm not just saying complete and utter nonsense to you. But yeah, so there's not a lot on real estate there, but if you want some stuff, I have a good amount. Yeah. Any other questions? Do you have one, you see? You good? Okay. Good. Let's see. On to the next one. So mitigating financial risk. So this is a really good conversation to be having with clients. Like I said, especially in today's world of just kind of changing things in terms of job availability and making sure that people are making an investment that makes sense for them. Also, like, you know, if you're working with real estate investors and a lot of times, like right now, the ROI isn't looking really great, or their cap rate isn't looking really great, because interest rates are so high, right? So it's kind of hard to make that extra income. So making sure that if, you know, they make this purchase, the tenant moves out, what are you stuck with? Can you cover that from cash flow? And making, especially like newer investors or new first-time home buyers, making sure that they can make those payments and it's not going to hurt them. Also, market downturn, obviously, like we didn't see as big of an impact as like Arkansas or, you know, somewhere in the Midwest in the last couple of years. But I'm sure you guys have seen at least a slowdown of listings, right? There's just, it's not nearly as competitive of a market. You're not getting like 40 people bidding on the same house for like $200,000 over asking. So it's a different market, but like readying your people for market changes too, especially with interest rates. Like I know I said earlier, like we don't see interest rates really coming down in the next year or so, but telling people when they're saying, oh, I'm just going to wait for interest rates to come down, readying them for the fact that we're going to go back to 40 offers over asking for $200,000 over asking, right? And do you want to compete with that, or do you just want to refinance your mortgage that you got this year down to whatever? Probably going to be like 5%. Let's be real, 5% is pretty great, right? Yeah. So having those conversations is really, really important. And also having the conversation of emergency funds. Do you guys have an emergency fund? Are you spending all of your money on the down payment for this house? I think there was a commercial, like somebody they bought a house and they're like sitting on the floor and they're like, when you spend all of your money and like there's like you don't have money for furniture, right? Like but that's a very real thing, right? Home ownership is such a desirable thing, like everyone wants to do it and it's a wonderful experience to have, but are you putting yourself at risk of losing this wonderful thing that you just bought?
So, because it's interesting, because there is actually a pushback from younger generation.
Sure.
About homeownership.
Right.
Because what the homeowner insurance has done.
Right.
Terms have gone up, and so there's people who have bought, who suddenly cannot afford because homeownership just got through the roof.
Right. Yeah, and I mean, insurance is a massive thing, especially right now. Like when you look at what happened in California.
Oh, yeah.
And I mean, I live in Issaquah and we got hit really bad by the windstorm. I had a couple of clients lose like their houses, or just had trees go straight through their house. They were fine, thankfully. But you know, what does that look like? And are you properly insured? And can you afford the insurance as well? So one thing I do with my clients every year is we actually go through your homeowner's policy and make sure you're properly insured, because 9 times out of 10 people aren't properly insured.
So you go over that with them, you don't
I do.
advise them to go to their insurance rep or.
Oh no, I'll tell them if I see that they're under, I mean, it's pretty easy to tell if somebody's underinsured.
Yeah.
From their declaration page. I mean, if you bought your house in 1984 and you haven't changed your insurance since then,
Pretty obvious.
you're pretty, yeah. I mean, most people, if you haven't changed your homeowner policy in the last 2 years, you need to update it. That's with how fast, with how fast stuff appreciates here. Yeah. Like, the question is, can you rebuild your house that you have right now with the insurance that you have on it if your house burned down right now? And majority of people, the answer is no.
Yep.
Right? Like, almost no one has proper
And
insurance.
that's probably because people are afraid that if their insurance is gonna go up monthly, of course, if they can barely afford it now,
Sure,
anything they choose through their policies.
yeah, yeah.
Make things harder.
But from an insurance perspective, like from the insurance company perspective, you know, they look at the risks associated. So
Right.
do you have a house in Eastern Washington that's by the forest that's gonna burn down? It's gonna cost a lot more, right?
Yeah.
If you have a condo in downtown Seattle, the chances of, you know, it burning down from a forest fire are pretty slim, right? So it kind of, I mean, it really depends on location too. But yeah, I mean, Washington's definitely seen an increase in.
Well, there's some
insurance.
places, because I went to the last month, Realtor
Yeah,
statewide convention, and then one of them from Cleveland was saying, they're not getting home insurance there.
totally. Yeah. Because it doesn't make sense. So basically how insurance works from the company's perspective is they have to have a base of like properties that are insurable. And a lot of them see those houses as uninsurable because of the potential of risk for them. They cannot have catastrophic risk, and almost all of them do. So from an insurance company like that, they're just not going to do it, right? It doesn't make business sense for
Yeah.
them,
Well,
which is
It's money.
which is why, I mean, you know, like in California, they have a state-run insurance company
Yeah.
that you can buy through. Still not affordable, right? I mean, I was listening to a guy on the radio, he was talking about how the insurance on his house cost more than his mortgage payment.
Wow.
Oh, yeah.
Oh my God.
Like, and we think it's bad here, but like, that's crazy, right?
Yeah.
So I don't think that it's gonna get to that point. I mean, not in this area, we get enough rain.
Were you hear Kelsey when they had the insurance person, I think he was.
That was really good.
And basically, he was kind of saying, there's a 3-year window, and the
Mhm.
3-year window is gonna suddenly, our rates are gonna go up
Yeah.
because they've been losing money.
Yeah, I mean, insurance companies are businesses, right? Like they have to make a profit, and at the end of the day, like it's just like your budget, right? If you have income coming in, which is your payments for insurance, and then they have catastrophic losses, they're paying out millions, if not billions of dollars to rebuild California. Where's that money coming from? And are they making money as a business? And if the answer is no, they're gonna pull out of the state. And we had that happen. I think 4 years ago, a lot of insurance companies pulled out of Washington because of our long-term care policy. I don't know if you guys remember that one. Washington mandated that people have to take money out of payroll for a long-term care policy run by the state or get personal long-term care policies. Because we were overloaded in the long-term care space. It didn't apply to business owners, so you guys probably don't remember that. But it was a big deal, and a lot of insurance companies pulled out because of that, because they didn't want to deal with insuring basically everybody in the state of Washington.
But
That has not come back around yet. It got
insurance
sued.
companies, because I remember when I was talking to someone, and actually as an insurance person, his grandmother had water policy, this is back in the 80s.
Yeah.
Suddenly, the insurance company just went through the roof, because suddenly now that was the whole issue about mold.
Totally.
There, and they said, no,
Yeah.
we're gonna have to charge this.
Well, and there's a reason that you have to pay extra for flood, you have to pay extra for earthquake, right? Because those are catastrophic, and they need you to pay more to have those things. Yeah. All right. Tax planning considerations, I know we've talked a little bit about this. With the 250,000 exclusion. A lot of people also don't know that they need to keep track of things that they've done to the house. Because that adds on to your cost basis too. So if I bought my house for $100,000 and put $100,000 into it, my new cost basis is 200,000. when I go to sell it, I have 200,000 plus the 250,000 on top of that as my cost basis. So it's important to know what you've paid into it in order to do that. Yes, you need receipts. Can't just guesstimate. The IRS does not like guesses. But a lot of people just don't know that, and they've lived in a house for 30 years and their appreciation's insane. And they might not have, you know, the receipts for it. So especially when you're talking to like first time home buyers, like, hey, if you make updates, just make sure you keep the receipts for whatever. So from a tax basis, when you go to sell it, you'll have them. Any questions on that?
Would that be like in a specific time frame though? Like, if, let's say they did some work like 15 years ago,
Nope.
10 years ago, you know?
Yeah, it doesn't matter. Anything that you put into it, you put, and it's yeah, like you can't do it for like a new refrigerator or something like that, but like repair like a new roof, a new like a structural like big thing, or you like renovated the entire inside of it, like that is all, yeah, that's all cost basis.
So does it vary according to whether it's replacement versus improvement?
Yes, it does. Again, not a CPA, not sure exactly what the things are. But yeah, so like if you know, rip out the carpet and put in hardwood, that's an improvement. That's,
Right.
you can add that onto your cost basis.
Tile.
Yeah, exactly. Better countertops, like whatever it is. So if you have people who are doing a lot of work renovating a bathroom, that can all go onto cost basis. My folks are getting ready to spend $35,000 renovating their bathroom. So
What bathroom?
it goes onto their, yeah,
So how would that like, you know, that
I know.
program that John Scott has,
Yeah,
Market Ready Plus.
yeah,
You're actually improving the property.
right.
So that could be something they could deduct from the cost basis.
Yeah, for sure. Basically, because they're paying that back, right? Like
Right,
it's a
comes out-
loan technically,
comes
but
out-
yeah, yeah,
Yeah, it comes out of the proceeds.
yeah. Makes a lot of sense.
So,
Yeah, if you guys aren't using that with your clients, use it. It's awesome.
it's called Market
Market
Ready
Ready.
Plus.
Oh, yeah.
And so,
Yeah, I've heard.
yeah, so it's a program basically that
Helps
allows
improve.
you to upgrade your listings to make it more
Mhm.
sellable. And I can't remember that basically they would put the money in front and then they basically, I don't think they have any interest for a while as soon as it sells. and
Yeah,
it Gets paid out of closing. So it's a great program.
I actually had a client that used it and it was awesome. Like she got, I think, 70,000 more and she spent like 25,000, you know,
Right.
and she used that program, which was awesome. So it's a huge value add if you guys aren't telling your sellers about it. Like,
Yeah.
hey, you need to improve this bathroom, right? And they're like, I don't have $25,000 to dump in here. Oh, well, we have this program that you guys can use. And that's a huge value add for your.
That and also like refer like just like random people who have them like upgrade the.
Yeah.
I mean, like might not be sustainable later on, you know?
Yeah,
Yep.
yeah, it's huge.
Easy for them.
Okay, obviously collaborating with CPAs is awesome because at the end of the day, your whole goal is to keep more money in your client's pocket, right? Then they have more money to invest with you later. So having that relationship with a good CPA is awesome. If you need CPA referrals for your clients, especially in the real estate space, shoot me an email. I'm more than happy to get you guys some good ones. I have 3 that I use that are phenomenal.
And this is something you would recommend for your clients, or would you also recommend for agents? And
Both. Yeah, they're all of them specialize in the real estate space
Okay.
and work with a lot of agents as well. But yeah, so like they just know your world really well, which not all CPAs do.
No.
It's just like not all financial planners know real estate very well. Like it's just something that I love because it's complex and fun. So not all are created the same. And then estate planning integrations. So really having good conversations about what's next for clients. With my older clients, I'll give you guys an example. I'm actually working on some mutual clients with Tony right now. And this family inherited a building in Ballard. It's a commercial building. And they inherited it from their parents. They're 3rd generation owners. And there's 5 of them. and they're all in their 70s.
Wow.
And
And they have 17 kids underneath them. And so now they're all in their 70s and none of the kids want it.
wow.
They're like, I don't want to deal with it. Like, I don't want to run that real estate's not my jam. And so the 5 siblings are having to sell that property. Well, they inherited it about 15 years ago. So you can imagine commercial property in Ballard has appreciated a lot since then. So they're looking at about $6 million of capital gains.
Oh,
So each one of them is also different, right? So they all want to get out of it, but some of them are charitable and want to leave some money to a charity, and there's strategies to get out of it. You can actually 1031 exchange into some different funds. You can put it into, there's called CRUTS, lovely word, Charitable Remainder Unit Trust. So some of them are putting some money into that. And what that does is it gets rid of the capital gains on that, however much you put in there. So let's say you put $500,000 in there, no capital gains. You have to leave 10% to a charity at the end of your life. That's it, 10% of the $500,000, regardless of how it's invested, whatever. And then you pull income off of that amount, that's the 500,000, and it's tax-free. So it's a strategy for some people. You can 1031 exchange. A lot of people don't know this. You can 1031 exchange into DSTs, Delaware Statutory Trusts. You can 1031 exchange into some REITs. You're not owning, you don't have to deal with the property, but you own basically a portfolio of real estate. You get monthly payments off of it. Most of them, like right now, they're paying anywhere between 8 and 10% a year in income. It's just like owning property. You get a K1 at the end of the year saying which property, what you got. But you 1031 exchange. Your kids inherit it. They get a step up cost basis. So you get out of owning the building, but you don't have to pay capital gains on it. You get to defer that. So super, super cool strategies. There's a ton more. I'm not going to bore you with all of them. But knowing what your clients want, and if they're all different, that's great. Knowing what they want is really important because the estate planning strategies can be very robust and fun, and they can save a bunch of money. Because a lot of people just think like, just got to realize the $6 million of capital gains. And a lot of them, you know, they're going to be paying 20%, 15, 20%, and that's a lot. Or you can leave 10% to a charity, right? For me, that's no brainer.
Yeah.
But if you're my aunt and uncle, you don't care. Any questions about that piece? Okay. Oh, on the last piece, I just put like kind of a call for you guys, just to be thinking about from this perspective of, you know, if you have aging clients and just having that conversation with them, like, hey, what's the plan for this property? Like, you're living in this house. What's the plan for the property? Like, is it in your will? Do you have a will? Everyone needs a will. And if they want to leave it to kids, a lot of people think that, oh, I'm gonna put the title in my kids' names, or I'm gonna do or I'll put it in a trust, and you don't always have to put it in a trust. And people have questions about what they should be doing. Just it's a good call out to just have a conversation with older clients, like, hey, what's the plan for this? Your kid's getting it. Do you have one kid who has a problem with drugs and like they're going to inherit this, you know, building, and you don't know what it's going to do to them? Because we can put it in a trust and the trust can distribute out, you know, 10 grand a year to that kid, and your other kid can get all their money up front. What do you want to happen? There are tons of strategies for clients. So that's kind of my call to action for you guys in terms of just being able to reach out to clients. So I have a fun case study. We're going to go over this And then I'm gonna make some changes to it just to talk through. So this is Pam, she's 65, she's getting ready to retire. Her husband was 15 years older, he just passed this year. She's thinking maybe she wants to downsize her home. She bought her house in 1980, paid $20,000. And she thinks she can probably sell around for a million. She comes to you for help. What questions are you asking her?
What's her?
Or what things are you telling her?
What she wants to do, the question and.
So she wants to downsize. She's thinking about selling. She's nervous about capital gains. What would you tell her?
Oh, she's nervous about.
Yeah, she doesn't have any.
Right?
Yeah.
So she has a full stepped up cost basis, right?
Yeah.
So that is wonderful. So you can tell her you have a stepped up cost basis. You have no tax implications from here. You can sell it, take your $1 million, go to Ocean Shores and buy whatever you want and reinvest it, whatever. Right? What if her husband passed away 10 years ago? And when he passed away, it was worth 800,000.
Well, that you have capital gains in the 200,000.
Correct.
Pretty much you said, yeah.
Good.
So,
But in this case, would it cover the 250 or no?
So hers, she would get the 250 with hers.
Cool.
So if your spouse passes away, you have that year basically to do something with it. But after that, then she's filing single essentially, right?
Right.
So after 2 years, you're filing single, and then you have the 250,000 exclusion.
She then would still pay no capital gains.
Right, exactly.
Wait till.
Yeah, so if she, and that's the conversation to be having with clients who are older, like, hey, you just lost your spouse. A lot of people just don't want to do anything drastic immediately, right? They want to stay in their house for a couple of years and then they want to have the conversation, which is totally fine. And you can give them kind of peace of mind with that, right? Hey, you're only going to pay capital gains on anything above this. In the next couple of years, this property is not going to go up, more than 250,000, probably. But at the end of the day, even if it does, you're only paying on top of that, right? So having those conversations and being really knowledgeable is really important. Any questions on that?
For your numbers in Chapel Hill are a little off.
I was just
In 1980, that was.
Easy math.
It's just easy math. It's just for the sake of argument, right?
1980 close to about 300,000. Now it's probably about 2 million.
Yeah. I'm like, whatever. I actually had a client,
Beacon Hill, yeah. That was.
yeah, I had a client who had a house in West Seattle. She bought in the early 1940s. And it was like on top of a hill, gorgeous views, just this little cottage. She paid $20,000 for it. And she's like, yeah, developers come talk to me all the time. Guess what they were offering her?
4 million.
Yep. 4 million.
You're lying.
Yep. And they're gonna tear it down.
Right.
Like they're just paying for the view, essentially. But yeah, she's like, no, I'm just gonna leave it for my kids. And I'm like, you are far nicer than I am. She's like, her kids get that huge step up cost basis when she passes away, and she knew that. She was like, perfect.
The only basis she'll get is like 2.1 million, isn't it?
Right.
Right.
Well, but that's just for estate taxes. But they'll get a full stepped up cost basis.
I see.
So it's worth $4 million. They sell it to a developer for $4 million. They're not paying any capital gains on it. But she knew that. She knew if she sold it for that, she'd be paying 15% on like basically $4 million, right?
And by the time they get it, it's gonna probably be worth more.
Totally.
How
Yeah.
big is a lot? Because that's.
It was like close to a half an acre.
Yeah. that's-
It was
yeah.
massive.
Yeah,
Yeah.
so that's.
For there, it was massive.
Yeah, being multifamily, it's.
Yeah.
You have 4 units.
Yeah,
And that's
absolutely.
units that you're looking, yeah. makes
Yeah.
sense.
So strategies, she knew that though, which is important. Cause she could have sold it and realized all of those capital gains, but we had the conversation of what's the purpose of this, right? And so she knew that if she left it to her kids, that they'd get stuck on a cost basis. So implementation strategies, really, this is just making sure that you're partnering with people who have answers for your clients, and educating yourself because things change all the time, especially in like the tax world. Every year it changes, which is lovely. But just keeping updated on those things as they relate to your clients and how they change is really important. And using technology, like there's tons of tools out there. Nerd Wallet has a ton of different calculators. It has just different topics that you can look at for your clients. There's just so much, there's so many resources out there, but if you ever come across something and you're like, I don't know if this is true, just email me and I'll be happy to answer questions too. So that's all I got today, perfectly on time. Woo. So if you have questions, this is my information. I think I do have some cards too. But on this QR code, if you just want to have like a conversation, that QR code goes to my directly to my schedule. And I'm happy to talk. I'm also in this office every Wednesday. So if you guys have questions, just come see me on Wednesdays. I'm always here.
Is that yourself?
What's that?
Yourself?
Yeah, that's myself. Indeed.
And then if we wanted to get recommendations for CPA, you said to.
Yeah, just email me, shoot me an email and I'll introduce you to all three of them.
Amazing.
Just be aware that right now it's crazy time for them.
Yeah.
So after April 15th, that's usually when they'll talk to you. I do have a couple that will talk to you right now, but after that.
It would probably be best like if people are kind of planning for this year to do it after, but I guess like
Yeah.
there's not much room for tax preparations for 2024 because it's.
Yeah, I mean, there are some strategies, especially as business owners, like if you've started doing your taxes and you owe a lot and you want to know some strategies for maybe saving for yourself instead of paying the IRS, there's still strategies that you can use. And if you extend until October 15th, you can also do that until then. So yeah, I can talk to you about like what those look like.
Yeah, I'd like to learn how to.
Yeah.
Share some more something like that.
Pay yourself.
Pay yourself, like, is there something I'm missing? Should I be putting this money rather than?
Yeah.
Taxes, can I not put in a Roth IRA or
So,
some sort of investment?
That's the class I'm gonna do next month is going to be like business strategies for you guys in order to save on your personal taxes,
Yes,
like
love it.
what you guys can do. I know a lot of you defer taxes until October 15th, so we're gonna do that next month and just go over like strategies for you as business owners, like what can you do? How can you pay yourself instead of paying the IRS?
Nice.
Yeah. Cool beans.
helpful.
All right.
Thank you, Kelsey.
Thank you, everybody online.
Well done.
That's.
Really good.
Yeah. 4 minutes.